Welcome to the First Property Buyer Show, your go-to podcast for expert advice, market insights, and real-life stories to help you buy your first home with confidence.
Hello and welcome to the First Property Buyer Show, the podcast that is with you every step of the way during your property journey. I'm Emilie Lauer, journalist here at Momentum Media, and today we are joined by Rob Shanley, a finance broker at Propple, to discuss how first home buyer can access the property ladder by investing with friends and family. Rob, thank you so much for joining us.
It's great to be here. Thanks, Emily.
Now, Rob, that is a very, very interesting topic we've got here. Investing with friends and investing with family other than a romantic partner, yeah?
Yes.
So about a couple of years ago, a NAB survey found that 40% of young Australians were actually ready to invest with a friend or a family member. That was a couple of years ago. I feel like now that number has risen even more. And you know what, for me, it's kind of crazy because there's really like two schools in terms of like, should you invest with your friends? And you'll see either, yes, go for it, it's a great thing, or no, never. Now, at Propple, you guys are a service and a technology company that helps, friends and family co-invest in property together. That's your specialty. What are some of the advantages to actually like co-invest with friends and family?
Yeah, look, I guess me being have an accountancy background, right? So to me, the financial benefits immediately jumped out, right? Obviously, you can split the cost of the deposit. You're splitting all the, if it requires refurbishment, interest costs, all those things. But, we reached out to some clients and the feedback was really interesting, right? So a lot of the benefits that they cited were non-financial, right? So they said it was, being part of a team, a part of a sort of a syndicate. A lot of them are, investing with, let's say, siblings, colleagues, friends, and they've got a plan. So they're saying, we want to get to X amount of properties by 5 years, 10 years. And they said one of the big advantages is that it keeps them accountable to each other, right? So if you're a solo investor, it's easy to take the foot off the gas. You've got a big year in work, or you've got, a big life event like a wedding or a baby arriving or something like that. And you can take the foot off the gas in terms of your investment strategy. So what they find is, one of their syndicate might be going through a difficult time like that, and the others can pick up the slack. So apart from the obvious financial advantages of getting on the property ladder sooner, splitting the cost of a deposit, which is getting, more and more unattainable, there's also the non-financial parts, that kind of team element, which, I guess me being the accountant, I hadn't thought of that, but it was quite interesting to hear that from the clients. Yeah.
Yeah, and that's something you wouldn't often think about because, like being accountable to your portfolio means you keep on building that portfolio, and having someone pick up the slack when you have that life event can definitely be an advantage.
Yeah.
How can that be a risk as well? Because, let's say we invest together. I'm having a wedding and a baby in the next, 3 years.
Yeah.
Hypothetically. And you have to foot the bill more than me. How do we manage to, keep that, 50-50? Or do you get more shares than I do?
Yeah.
How is that structured?
Look, in those situations, first thing, it's got to be someone you really trust, right? So that goes without saying. And that's why we get a lot of, siblings, very close friends, cousins, people who are connected anyway through life, right? So that's the first thing. The next thing, one of the bits you need to get right at the outset when you're co-investing in property is a co-ownership agreement, right? And that's some of the value that we can add by guiding you in that process. So that sets out basically the rules of engagement, right? And it says, okay, well, here's what happens if we have an unexpected refurbishment. Here's what happens if, one of us needs to sell. Here's our exit strategy, So setting out those ground rules at the very start avoids those disagreements down the line. And, where we can add value is we know what those problems are that are going to occur down the line, right? Because we've seen it all. So, I think making it very clear and transparent at the start can avoid the usual pitfalls that, co-investors have down the line.
Yeah, and we're going to talk about those pitfalls a little bit down later in this podcast.
Yeah.
Now, you mentioned, investing with siblings, investing with cousins. This is family, yeah? Family is thicker than everything.
Yep.
How different is it to invest with family and with a friend, for example? How have you seen that?
Look, not all that different, right? The big difference is, are you investing with your spouse or are you investing with someone other than your spouse, right? Because the key difference is and I don't want to get too technical, but survivorship of the portion of property you own, right? If you buy with your spouse, it automatically, everything, let's say you get hit by a bus, it automatically goes to the person you're investing with, your spouse. Now, if you're investing with friends or, as you said, cousins, siblings, the structure that we're seeing is really popular at the moment is a tenants in common purchase, right? So that means that you have control and ownership of your portion of the property. So that's where it's a little different than just purchasing with your spouse. And lenders are cottoning onto this, right? So lenders are actually developing products to tailor for this kind of emerging way of investing. Okay, so we're seeing that. We're seeing lenders come to us and say, "Hey, have you heard about this product that we're doing? That there's no joint and several liability. You've got control of your own portion of the loan." So we're seeing this emerge as a real trend, and that's the big difference. That you purchase with a friend, a cousin, a sibling. You do it through that structure, and you've got control of your portion of that property. You can sell it on. You get hit by a bus. It goes to whoever you want it to go to via your will or whatever. And that's what makes it quite different to purchasing with a space. Yeah.
Very interesting. Look, I'm sure many of our listeners have at least once thought, oh, maybe I should invest with, so-and-so. That's my best friend, let's go for it.
Yeah.
How does that work? Like, what does the process look like if they want to, jump in and be like, okay, let's do it?
Yeah. Look, to boil it down, there's like three things you really need to get right to make this work. Okay. So the first is the structure. Do you need to set up a trust? Do you need to set up a limited company? Or do you want to purchase directly as tenants in common? Right. The next thing is the co-ownership agreement, which we spoke about, setting out those ground rules. And we spoke about, how you share expenditure and unexpected repairs and things. The exit strategy is a big part of that as well, right? So we've seen different things. So some people say, okay, well, when the property gets to X value, we all agree that we're going to sell, okay? Other people say we're going to sell in 5 years no matter what. And then some people, it's a combination, right? Where they say, all right, we want to get to this valuation, but if we haven't gotten there in 5 years' time, we're going to sell anyway. So, setting out that at the start is so important to, again, avoid that disagreement down the line. And then the third thing is your finance, right? Your home loan. So we're accredited with all the major lenders. We know what lenders will lend to a trust, what lenders are best to lend to tenants in common. And that's where I guess we can really add value, first of all, but it's also what makes the model work really well, right? Because we take a brokerage fee from the lender, right? So we as a customer, you're not paying a cent to Propple. We are, in the same way as a broker would, getting a broking fee from that lender that you get your loan through. So I think that's what makes it quite a popular service, because it's effectively free for the user to avail of it.
Yeah, and look, talking about deposits, like mortgage responsibility. How do first home buyers, because first of all, first home buyers, they don't have that insight that investors have. It's their first property, yeah. So when you're already buying your first property, you've got to learn so much. Yeah. Hence why we've got this first property buyer podcast. But you've got to make sure you can service your mortgage. You need to understand, the product you're buying. You need to have that deposit. So it's a lot of learning.
Yeah.
How do you manage all of that while you're buying with someone else?
Yeah, it's a good question. I'd say, well, more heads are better than one, right? So, if you're buying with people, hopefully one of your group might, maybe they have some experience in property or in finance or something. Even if they don't, it's good to, I guess, pool thoughts and it's always daunting as a first-time buyer, right? It's never going to be easy. And if you're doing it as a group, that's no different, right? But I guess we put ourselves forward as a point of contact and a resource that you can use to make the process as easy as possible. Again, never an easy process, but if you're doing it with more people, more brains, and also having us, maybe you can lean on for a bit of guidance. Yeah.
Yeah, and look, we talking about deposits. The new 5% first home buyer scheme is coming up 1st of October. Can you actually use that scheme to buy together?
You can.
You can.
So,
okay.
Yeah. So, look, you can actually avail of that scheme. Now, look, the thing is with that scheme, you need to live in the property,
Yes.
right? So that's the key thing. So, yes, you can. Are you going to be purchasing a property with a friend that you're then going to live in? It's actually happening more and more. And we've seen couples buying together as as four investors and actually living in that property for a period of, their goal is to live in it for 5 years. And then each couple might have kids and they might move on, right? So it is absolutely possible to avail of that scheme. But we also have, a market of people that, look, it's a generational change, okay? So when our parents were getting married, so in the 70s, the average age to get married as a man was 23 and as a woman was 21, right? And then the average age to buy your first property was 25, right? That's all shifted 10 years, right? Now the average age to get married is over 30 and the average age to buy your first property in Australia is 36, right? So that's all shifted out. So there's a real portion of the market that are, let's say, in their late 20s, early 30s, who maybe they haven't settled down, but maybe they want to invest in property. And that hasn't been something that was around in our parents' generation. You get married when you're in your early 20s and then you buy a property when you're 25, right?
Yep.
Now, affordability is a huge factor in that, right? Nobody can afford a property at 25. But you certainly can't if you're single, which most people are, And, when I was 25, I was living in a share house with my mates, right? And I think a lot of people are in the same.
I feel you.
Yeah.
Yep.
So, look, there's definitely been a real, I guess, demographical change that has, created this market of people who maybe they're not ready to purchase a property with their forever partner, but they still want to enjoy some, capital appreciation and get involved in the property market a little sooner than 36. Yeah.
Yeah, no, definitely. And look, it is definitely something that the new generation is approaching. I mean, in 1970, the property prices, they were not the same either. Yeah.
Of course.
So
yeah.
it was way easier to enter the market, less competition on the top of it.
Yeah.
Maybe a little bit more supply. So kind of like, in a way, an easier market.
Definitely. There's no doubt. Yeah.
Yeah, well, I mean, look, playing the devil's advocate's wages were like a little bit less. Let's put it that way. Yeah. Like
interest rates were what, 17%?
Yeah,
and it was totally different, right? But,
it's a very different market.
Yeah.
So what sort of co-ownership are you seeing at the moment? Is it 2 people or is it more? What's the optimal, way to co-invest there?
We're seeing a lot of 2 people. Yeah. There's no optimal really, we're seeing anything up to 4 people. 2 people, who are not necessarily spouse or romantic partners. We're seeing a lot of that because, again, you're not dealing with the whole plethora of different ideas and goals and objectives. But we're seeing a whole variety. Like we're just seeing a massive. So there's a loan product that has only been developed in the last number of years that specifically tailors for tenant in common purchases. Now that lender released a publication a couple of months ago. They said inquiries for non-standard loans has increased by 30% in the last 12 months. Like, that's pretty huge, and we're seeing the same thing. So, for us, it's like this is a trend whether we exist or not, right? Like this is happening whether there's a Propple or no Propple, and we certainly think there's a place for us in that landscape to guide people along the process.
Yeah. Well, you mentioned something like, everybody has different goals, and I feel like in this way, like the more the merrier maybe does not apply. You know what I mean?
Yeah, maybe not. Yeah.
Maybe not. How do you manage, we talked a little bit before, not having everything set up, like from the get-go. But how do you manage, if people life circumstances changes and their goal changes and they maybe want to review that agreement? Is that something that is possible, or once it's set, you're set?
Yeah, no, like, look, any agreement can be changed by mutual agreement of the parties, right? So that goes for most contracts. If all parties to the contract agree to an amendment or a change, well, then you change it, right? But I guess the importance is to have something, right? You got to have something in writing so that if you revisit it 3 years, 5 years, 10 years down the line, you've got a basis. And but yeah, anything can be amended or changed by mutual agreement of the co-purchasers. Yes.
We talked a little bit earlier about the pitfalls, so you give us a little bit of a teaser over there. What are some of the most common mistakes or some of the pitfall first-time co-buyers make, and how can you avoid them?
Yeah. And look, I don't want to sound like a parrot here, but it's the co-ownership agreement, right? Setting things out at the start. But the pitfalls, so not selecting someone carefully who you trust, right? And I suppose that can go with any property purchase, even with your spouse, right? So you don't know anything. So you need to be very careful in terms of who you choose to co-invest with, and then you need to make sure your goals and objectives are broadly aligned, right? So we get a lot of people. They say, look, we just want to put our money somewhere that hopefully it'll appreciate over time, and we're not ready to buy our forever home now, but hopefully in 5 years' time, our deposit will have turned into a more significant amount of money, and then we can go our separate ways and we can purchase our own properties with, maybe at that point in our lives, we're ready to purchase, with a spouse or someone else. So perfect. Goals aligned. Okay, we've got a sort of a time frame. We're saying, okay, let's say 5 years time, and then it might get close to that 5 year window, and as you say, you might mutually agree, okay, well, let's extend it a few years, this is going okay, or whatever. So again, picking someone that you trust, that your goals are reasonably aligned with, and then you crack on.
How do you handle disagreements that are not written down?
There won't be any agreements not written down if you go through us.
Yeah. I mean, like more in terms of like general thingy, like, you're having disagreement with your spouse, when it comes to property, like not even buying the property, you don't always agree. Yeah. So when it's your spouse, it's your spouse. Yeah. So it makes it easier in a way. How do you handle those kind of disagreements, on a day-to-day, property investment way, when they're not written down?
Understand. So this is more kind of strategic disagreements, right? What we should do with the property, and again, it's agreeing an exit strategy at the outset. But I understand your question. Even when you agree an exit strategy at the outset, there might be disagreements down the line as to what you do. Yeah, life changes and goals change, right? So of course, again, the default is always to go back to what you have in writing. But then, I guess like with any disagreement in business or in your personal life, you sit down, you have a discussion. If you can mutually agree on something, the beauty of the tenants in common structure, right, is that everyone's got control over their portion and ownership of their portion, right? And they've got their finance separate. So they've got their loan on their portion of that property. So they can sell that. If they want out, right, they can actually sell that portion of the property, and the other 2, 3, whoever can continue on owning it. So the structure itself gives that freedom down the line to, alleviate some of those issues that you described, because you actually have control over your portion of the investment.
So more flexibility, yeah.
Oh, hugely. Yeah.
Very interesting. How does, co-owning a property with somebody impacts your borrowing capacity in the future?
Yeah, like you hear horror stories. So, and this is one of the reasons that we felt there was a place for us in the market, is that we heard of people co-purchasing property, 4 people, not realizing they're joint and severally liable for the entire debt, each of them. So they go to buy another property, and the broker says, "What are you talking about? You've got this massive debt." Now, we know what lenders will loan to a, for example, to a trust. We know which ones have joint and several liability. We know which ones can split out the loan so that you're only liable for your part. And that's like obviously a big value add of ours, that we're in that sort of niche space, to the point that we have, as I said, lenders coming to us saying, "Hey, have you heard about our latest tenants in common product?" So, look, yeah, you hear horror stories, and it's one of the reasons that we're here, because it can be a minefield if you're not getting the right advice.
Yeah, so you gotta be careful in there.
Yeah, you got to be careful. Absolutely. Yeah.
Okay, we talked a little bit about exit strategy. What's a good exit strategy when you're actually co-owning property?
A good exit strategy is one that's clearly defined, right? It doesn't really matter what it is, right? And also, we're not in the business of saying what their strategy should be, right? That's So, what we see is that if it says, we want to sell by a certain date, we want to sell by a certain valuation, we want, until we've got enough for a deposit of our own, something that is like a clear, defined monetary amount, something that's easily measured, is a good exit strategy, because then there's no ambiguity, right? And there's no disagreement when that time comes, because it's like, right out, we've got, now we've got a valuation of $1 million. We all agreed we're going to sell at this point, and there's no disagreement. Yeah.
Realistically speaking, how easy it is to go as a first-time buyer and buy something with your friends or your family?
Well, look, a lot easier than if you're doing it by yourself, right? Because the big challenges now are, there's a couple of challenges, right? First, interest rates are relatively high. I know they're coming down, relatively high, historically speaking. And the next thing is that asset values are astronomical. So you're trying to save up for a deposit. And even when you do, you're paying enormous interest rates. So look, the first home buyer schemes go some way in tackling that. But there's some issues, right? Because fine, you can give a 5% deposit and you can buy your property. Then you're borrowing 95% of the value of the property, and you're paying interest rates of, at the moment, 6% you're going to be, it's going to be cheaper renting. So, the idea that you can actually get together with some friends, family, co-investors, and we'd encourage you to try to get to a 10-20% deposit. So at least then you're not going to be underwater when you're, because obviously if you're buying 95%, you're going to be underwater for a long period of that loan. So, yeah.
Yeah. Look, and that's the whole, 5% scheme. That's the whole, drawback of it. 5% with no lender mortgage insurance. Fantastic idea.
Yeah.
95% mortgage, which means also 95%, the interest on that amount.
Exactly. Yeah.
Yeah, I think that's where people, don't always think about, which is a lot of money to be paying back, and a lot of money to pay back every month to have those repayments set up.
Yeah.
Which I think, if you do buy with somebody else, you can split those costs.
Yeah.
So quite interesting. Now, would it be the same if parents were to buy with their kids?
Yeah, look, it can be like a more typical structure there is that the parents would go as guarantor. Maybe they've got assets that they can use to guarantee a son or daughter's loan. But absolutely, it can be any 2 people, 3 people, 4 people. Yeah.
All right. Any last advice for our listeners who are first-time buyers if they want to go and buy with friends?
Last advice if you want to buy with friends. Look, do you know I spoke a bit about feedback from clients, right?
Yeah.
And how we got a bit of unexpected feedback. One thing that kept coming up is that it's fun, right?
Okay.
Because, you've got people who are friends, they've got a project together, they're catching up once a month, having a beer, chatting about, okay, well, what's next? And the enjoyment that the clients get out of it is actually awesome. So I suppose, my last message would be that this could be a really cool thing. Keep a group of friends together, keep them engaged, and building wealth together. So, yeah.
Very, very interesting. Well, Rob, thank you so much for your time today. That was the First Property Buyer Show here today with Rob Shanley, finance broker at Propple, to discuss how first home buyers can access their first property buying with friends or family members. In the meantime, we'll be back for another episode next Monday. Bye for now.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.